Hi, this is Michael Fisher for SavingAndInvesting.com, and in this brief video I'd like to speak about mutual funds and fees, and in particular focusing on load fees or no load funds and expense ratios. Now, mutual funds, as we've seen, whether they're actively managed or passively managed, charge some fees. And some of the terminology that's going to be discussed in this video refers more to the US, particularly with respect to loads and no load funds. Having said that, however, the overall principles of fees and how to think about fees and reading prospectuses and trying to minimize fees and paying only for those fees that actually add value are concepts that can be universally applied and applied to all funds, whether they're mutual funds in the US or funds in other countries or unit trusts in the UK. Now, mutual funds in the US will have certain fees. First of all, they'll have load fees typically, or they can have load fees, which are like a commission that can be charged either on purchase or redemption of the mutual funds. Furthermore, they'll often have distribution fees, which in the US are known as 12b-1 fees. And when a load fee is typically a commission that goes to the broker for selling the mutual fund to the investor, and when either when the fund is bought and they're referred to as front-end fees, or when the fund is sold, in which case they're referred to as back-end or redemption fees. Clearly, all other things being equal, not paying a load fee either at the outset or on redemption is much better. For example, if we as an investor invest $100 and there's a 5% front-end load, then for every $100 we invest, we're actually only going to end up investing $95 because of the 5% commission that reduces the invested amount right at the outset. So clearly, all other things being equal, avoiding the load fees is a very good idea. And just because a fund is called a no-load fee doesn't mean it's free of charges. It just means it's free of these load charges, which are like a commission. A no-load fund would typically still charge a distribution fee, and the distribution fee is in the US known as a 12b-1 fee. And a no-load fund that doesn't charge this distribution fee is also referred to as a true no-load fund or a 100% no-load fund. Now, no-load funds typically do not charge a commission that is either a front-end load or a back-end load, but they definitely can still charge the 12b-1 fee, so that's worth watching out for. And in having said all of that, in mature markets like, for example, the US equity market, with, for example, a mutual fund that's benchmarked to the S&P 500, there will typically be no-load funds available as an alternative. So there's no reason typically that the load that's applied to a mutual fund adds a lot of value. It's in most cases a commission that goes to a selling broker. Now, to run a mutual fund, there are clearly also operating expenses that are often passed on to the investor. These include the distribution charge that we mentioned, the 12b-1 fee, and the cost of portfolio management, the cost of trading, the cost of research, the cost of holding the securities, and other administrative fees as well. Now, these charges, when they're passed on to the investor, obviously eat into the net performance of the fund. And apart from a potential distribution charge, the other charges that can eat into the funds are the costs of active management, i.e. the cost of paying a portfolio manager and a research team potentially to analyze securities. And as we've seen in the video on market efficiency, there's a lot of debate about whether active management in very mature markets actually adds value, and whether, especially in light of the additional fees that active managers incur and that are passed on to the investor, whether the net performance of an actively managed mutual fund in a developed market outperforms a passive strategy that merely attempts to mirror the index and typically has much lower expenses that are passed on to the investor and that eat into the performance. And there are many books on this subject that will argue that passive management in mature markets is definitely the way to go. And this is where we really have to ask ourselves the question whether active management is going to add enough value to justify the incremental fee. In very efficient markets, as we've said, there are a lot of studies that indicate that active management does not, because the active portfolio manager is not able to pick the undervalued securities consistently, and because there are so many people trying to do the same thing, and because of the incremental fees incurred, that active management doesn't outperform the benchmark on a net basis or passively managed funds on a net basis. The lowest the lowest expense ratios and tend to be for passively managed funds, and that the expense ratio is expressed as a percentage, and it's the annual percentage that an investor pays for the mutual fund, separate from the load and no load matters. So if we look at the expense ratio of a fund, it gives us an indication of what the costs are of the fund, excluding the load and no load matters, i.e. the load charge, which we'd have to look at separately. But assuming it's a no load fund, then the expense ratio looks at what the costs of management are on a percentage basis on an annual basis. A lot of mutual funds will also show in their performance gross performance, i.e. before any charges, so it's very important to look out for that and to look for the expenses, the performance on a net basis, or to understand the expenses very clearly. Gross performance is obviously performance without taking into account any loads, management fees, or other charges. Looking at these charges is therefore crucial to understanding how the fund really performed. And we can say that all of these charges eat into the net performance, so we have to look at them very closely. And there are a lot of reasons, including market efficiency, to look at passively managed funds, but also to aim to avoid the load charges, to look at index funds from reputable providers. The key is to be aware of these charges, the no load and load issues, particularly in the United States, the additional distribution fees that are sometimes charged, and the expense ratios and the impact that this can have on a net performance, especially when we're compounding at different interest rates. If we remember, the difference between compounding at 3% or 3.5% over a very long period makes a difference in the end result over 10 or 15 years of much greater than 0.5%, because we're compounding to multiplying by 1.03 or 1.035 many times. And if the percentage return on a net basis is better, it makes a significant difference, all other things being equal. And obviously one has to look at the tax implication as well. So the overall message is to look at the cost of mutual funds very carefully, to be aware of the load versus no load issue, to also to be aware of the costs of the portfolio management and the expense ratio, and to compare like for like, and to understand these fees, and to pay for the things that are actually worth paying for, that add value to the investment process. Clearly a commission goes to the broker, the management fees may clearly go to the active manager, but then it's worth asking ourselves whether active management will actually outperform the benchmark. And there's a lot of debate, especially in very mature markets.